Good morning and welcome to today's Five with Fitz. The rally looks to be taking a slight pause this morning following the S&P 500's longest winning streak in more than a year. I say good. Big gains are like a big meal, which means that having a little time to digest things before the next run higher or dessert is a good thing and a sign that they're working normally. Now, companies and investors who hesitate become footnotes, but the ones who lead become empires and legends. So know who you are. Take a look at an image in the written version of Five with Fitz. Here's my playbook. Number one, is it time to buy Marvell? Well, NVIDIA's CEO Jensen Huang took the stage at Computex in Taipei and called Marvell Technology the next trillion-dollar company. I don't disagree, by the way. Marvell promptly jumped 22% before the opening bell and is now up roughly 19% to 262 bucks. So is the company truly unique and worth a look? Well, perhaps. Marvell makes the connectivity chips that let AI data centers actually talk to themselves, meaning sharing data across thousands of chips at once. Now, scientists that I've spoken with suggest that AI clusters get bigger and that capability, the plumbing, becomes more valuable, not less. Now, here's the challenge. The big money did what they almost always do. They bought before Jensen took the stage. Now they need someone to sell to. It's a classic greed-based setup, which is why my 2 cents is that you want to let earnings chill a bit first. Then if Marvell has legs, it'll be a great company next week, and you'll potentially have a much better entry point to show for your patience. Trade ideas, well, lowball orders or selling cash secured puts are great. If there's a drop to capitalize on rising volatility, that could work nicely. But if you've already got shares, well, you know what? Selling covered calls to lock in profits or even generate a little income could also be a great way to go too. Now, if you're an OBAer, I've detailed all three of those strategies in past issues, as well as the recent OBA options bootcamp. Videos are available via the members portal, so check those out. Keys investing tip: patience and discipline are the most undervalued assets in the market today, in my humble opinion. Number two, Berkshire buys Alphabet. Again, now I got to admit, I feel pretty darn smart for saying that Berkshire's new CEO might get with the program and rush into AI. But to be fair, I could have simply been lucky. So there is that. Berkshire just made a $10 billion investment in Alphabet. Interestingly, this deal is a bigger part of the planned $80 billion sale Alphabet is using to fund AI. So people are interpreting it as a sign that Berkshire thinks Alphabet wins the AI race. And I get it, right? Berkshire has already increased its Alphabet stake by something like 225%, 21, 26. This private placement plows another, 10 billion on top of that. I see the other side of the coin though. And what this tells me is that Berkshire knows it's behind and then Alphabet was willing to play ball. Winning or not has absolutely nothing to do with this. The AI race has no off ramp. That's what you want to focus on. But I question whether Alphabet is really the play here when there are other choices with what I consider to be far better path to profits. Keys investing tip: the smart money doesn't finance trades, but it almost definitely tends to finance them. So buy the best, ignore the rest. All right, number three today. Most investors could double their exposure and still not have enough. Blackstone, yeah, those guys, just raised $13 billion in change from institutional investors, pension funds, sovereign wealth funds, family offices, all of it specifically earmarked for Asia deals. Now they were asking for 10 billion, but got 13 billion. Let that sink in. Some of the world's smartest institutional money just oversubscribed an Asia Pacific fund by roughly 30%. Now we're not talking ticker tourists or the blue plate special gang here chasing hot stocks. These are people who get paid to be right with other people's money, and they just voted with $13 billion of it. Now, I totally understand where they're coming from, having helped institutions make similar decisions over the years, many times. But here's the thing. If the average Westerner saw how fast Asia has changed and continues to change, they'd soil their pants. I've heard more times than I can count from people visiting for the first time or something similar, more family friendly. Most investors could double their exposure and still not have enough, in my humble opinion. Now, to be clear, you don't need to go all in or pick individual stocks to get started, but you do need to be honest with yourself about whether your portfolio looks anything like where the world is actually going or whether it still looks like 1995. Now, as always, I've got a few ideas if that's helpful and you know where to find me. Keys investing tip: missing opportunity is always more expensive than trying to avoid risks you can't control or because you simply don't like something, as in you don't like China or you don't like anything else in that part of the world. All right, number four, oil, tobacco, and booze. And now this, how times change. It used to be that you could count on three types of investments whenever sentiment soured or took a header: oil, tobacco, and booze. Customers tend to burn, smoke, or drink more of all three when they feel pinched. Now, apparently, lingerie is on the list too. Yeah. Victoria's Secret just raised full year guidance after obliterating Q1 earnings estimates. Now, I find it interesting that the company grew sales with what CEO Hillary Super says were significantly fewer promotions, particularly with shoppers 18 to 24 years of age. Now, Super's been working diligently on redefining and reconnecting the company with its core consumers, and it would appear that it's quite literally paying off. Shares are plus 46% as I type. Yep, or record this anyway. Ordinarily, I wouldn't even remote consider a stock like Victoria's Secret because it's nice to have versus the must to have, which is always my preferred hunting grounds. But in this case, I'm fascinated by a CEO who clearly understands her marketplace and who appears to be laser focused on reconnecting with the brand's best. Never mind legions of fans. If Wall Street decides sexy is back, I could see $75 a share 12 to 24 months from now. Bleeps could be an interesting way to play it, and a more affordable way to place that bet. Attractive too, pun absolutely intended. Thinking of which, I might need to go do some shopping for my bride now that I think about it. All right, number 5 today. Is it finally time for social media to pay the piper? I have long argued that social media execs have never been held accountable for what they foisted upon the world in the name of collecting followers, higher social media ratings, sharing photos of your pet hamster. I mean, could we finally be at that point? That's what I find myself wondering this morning. Florida's Attorney General just dropped an 83-page lawsuit on OpenAI and CEO Sam Altman, claiming that ChatGPT has harmed minors, aided mass shooters, and driven vulnerable users to suicide. This is the first state level lawsuit of its kind. Now, AG Uthmeyer wants to hold Altman personally liable. I say good. The damage has been staggering and well documented for years. Teen suicide rates have climbed in lockstep with smartphone adoption. Social media pylons have ended careers, destroyed families, and in too many cases, ended lives. Alleged mass shooters have been radicalized in plain sight on platforms that monetize the outrage. Eating disorders, anxiety, depression. Researchers and erstwhile pundits like yours truly have been ringing the alarm bell for a decade, while the platforms have counted their ad dollars. Congress has repeatedly hauled in Zuckerberg, Dorsey, and the rest of them up to Capitol Hill, made them swear an oath, and then nothing but stern questions, stammering answers, and carefully lawyered up non-apologies for their actions. Nobody's paid a real price except for the victims. My POV is that if the suit sticks with Altman, and I think there's a growing possibility or probability that it might, the template gets copied and fast. Suddenly, social media executives who've been skating for a decade while hiding behind the Digital Rights Act are looking at a very different legal landscape than the one they grew comfortable in. The "we're just a platform" defense has been the get out of jail free card for 20 years and then some. But that's the thing about paying the piper, though. Pipers don't tend to forget. They wait until somebody pays the bill. So, what do you do if you own social media companies? Well, here's where it gets nuanced. Think hard about which AI and social media companies you actually own, not whether you own them or to own them at all. This lawsuit doesn't change the trajectory of the technology itself, but it does potentially have an impact on who survives long enough to profit from it. Now, I can think of one company that's already a clear winner because they have prioritized safety and privacy from the get go. And frankly, I hope I'm smart enough to buy more shares because I probably don't own enough. How about you? Anyway, today's bottom line: most investors and traders worry incessantly about what might happen, but the most successful focus on what's likely to happen. There's a big difference. Now, and as always, let's make it a great day. Thanks for watching. I'll be in a more permanent studio here in a couple weeks, so forgive the casualness, but I hope you enjoy the message anyway. Cheers. You got this. I promise. See you tomorrow.